If you are a small business owner and you have any level of depreciation, there is a good chance that you're probably leaving money on the table. The problem is a lot of people don't understand how complex depreciation is. So let's break it down. What the heck is depreciation? Well, if you have a fixed asset, and a fixed asset is going to be anything that has a life longer than a year, generally speaking. So I'm talking about big things, right? Like cars and big computer equipment, servers, houses, fixed assets. Okay. These are the things that are really big. Or if you have bought into a type of business where you've purchased something called goodwill. Okay. Goodwill is something that we can amortize, which is just the sister of depreciation. But these are big things that usually have a life longer than 1 year. And if they have a life longer than a year, then the IRS says you can depreciate them or take a deduction for those fixed assets every year over time during the life when this thing exists. Problem is, those rules have a whole bunch of things happening with them. So, if you don't understand depreciation, you're likely leaving money on the table. And let's go through all the different ways in which you could potentially write off a fixed asset. So, the first, we have something called a de minimis exception. And this is going to be for fixed assets that might have a life longer than a year, but generally speaking, are going to be less than $2,500 in cost. Likely, if that's the case, we're going to be able to take the de minimis exception and write off that fixed asset entirely in the first year it gets put in service. So that can be really helpful. The second way that we could depreciate fixed assets is that we have something called Section 179. Section 179 is really cool. It is a code section that allows us to basically take the fixed asset and take the entire cost of the asset and expense it in the first year that it's put in service. Now, again, 179 can be great, but it can also have some hiccups. And the hiccups are you have to have enough income to take the deduction for the expense of the fixed asset. So when you're looking at your financial statements, the 179 deduction cannot push you in below zero, basically speaking. So you need to have enough income in your business in order to take the 179. And then the third really a third way that we have an ability to depreciate fixed assets would be through normal makers depreciation, which is just a fancy word, makers or straight line, which is just a fancy word for the code section kind of regulations. No big deal. We get to take the fixed asset and use it according to a pre-prescribed lives according to the asset. But we have something that came back with the OB3 that is now allowing us to take bonus depreciation. And what bonus depreciation does is it sounds kind of like 179, but it's a little bit different. And what bonus depreciation allows you to do is take the fixed asset and write it off entirely 100% of the fixed asset in the year one, if you so choose. But you would be able to force the income from your business into a loss, which for certain individuals could be really helpful because you might have other sources of income that you can use this loss to net the two things together and get you to a better tax bill or, a tax number at the end of the day. Now, how do you know which one to use? Well, that's really where the complexity comes into place. So in addition to these kind of three main ways that we can depreciate fixed assets, there is a whole host of other situations where we have to know kind of all of the different parts of what's happening in the business to figure out what the best answer for you is. Okay, this is not a one size fits all. Some people could have the exact same numbers of assets and have very different outcomes depending on lots of other factors. So this is where we get into the knowledge of understanding that, for instance, if you buy a new rental property, it is possible that a cost segregation study is going to be really good for you in the first year of service or maybe within the first 2 years. And the reason for that is that we're going to be able to segregate out the different costs of that fixed asset and take them according to different lives. Why does that matter? Well, let's say that you're going to do a ton of improvements on that property. If you're going to do that, we might be able to take some of those fixed assets that you're going to eventually pull right out of service and then take the deduction for those early on so that you can also then take the deductions for the new improvements that you're doing. But again, that's a facts and circumstances type situation, and it's going to depend on what your intention is for the property. So, the reason I bring this up is there is a lot of people who are either doing it yourself on fixed assets or they're using a tax pro who's not super well versed in understanding the ins and outs of depreciation. And the answer here is that there's really not one size fits all, and you need somebody who understands all of these different rules and regulations around depreciation to get you the best answer for your personal situation. Because filling it out according to what the computer told you is probably not always going to be what's in your best interest because you don't know what questions to ask. So, we're going through and saying, well, what's the long term plan for this asset? Are you going to sell it? Are you going to improve it? Is there something that's really old that's going to need replaced? What is your other income situations? What's the entity that you're doing this through? Do you have sufficient basis to take these losses? Like lots and lots of different questions. And all of it comes back to understanding you, the taxpayer, your personal goals, and your personal behaviors in how you're running your business. So, depreciation has a huge host of ways that it can be super beneficial to most taxpayers, but you have to know how to use it. So, I want to know from you, have you ever had something, a big fixed asset that you've put in service and you actually didn't know what you were supposed to do with it? Or so you figured out later that you had missed taking a deduction for a fixed asset that you should have been able to take a depreciation deduction for. Okay, both of those can be resolved, but if you've ever done that, let me know and let's see who has had a situation where they kind of missed out on a big deduction that the IRS gives us. It's in the tax code. We're not doing anything wrong. We just have to know how to play the game. Remember, as always, life is taxing, but your business shouldn't be.